All right, welcome back to another episode of the Jon Gil Podcast Show. And on this episode, we are super excited to bring on a very special guest. But before we begin, we want to go ahead and thank our partner, Element Studios. That's EL3 MENT Studios. Go ahead and check them out. They do great corporate headshots, real estate photography. And as always, if you like what you hear, hit that like button, subscribe to the channel. On this episode, again, we are super excited now to introduce Travis Watts. How are you, sir?
Hey, John. Thrilled to be here. Thanks so much for having me.
Awesome. Well, Travis is a full-time apartment investor and director of investor relations at Ashcroft Capital. And Ashcroft Capital controls over $900 million in assets and growing. He has invested in real estate since 2009 in multifamily, single family, and vacation rentals. And he's invested in over 28 passive syndications between 14 different firms. So we're very excited to have you on the show here today, Travis. Thank you so much.
All right. You bet, John.
Yeah. So Travis, tell us a little bit more about yourself and about Ashcroft Capital.
Sure. Yeah. So as you did a great job there on the intro, full-time passive investor, man. I got started probably like a lot of people get started with real estate. I bought a single family home in my own backyard, so to speak. And just kind of, it was a gradual, humble beginning. I didn't really know what I didn't know. I didn't know really what my goals were or where I was going to end up with this whole thing. But the first thing I did was I started house hacking. So I took that 2-bed, 1-bath house that I'd bought, rented out the spare bedroom. When I realized that was basically paying my mortgage, that was kind of a light bulb moment. That inspired me to keep going with real estate. I later turned that into my first full-time rental and moved out. And I did a whole bunch of strategies from fix and flips, vacation rentals, buy and holds, house hacking, owner-occupied homes that I would fix up, all kinds of stuff from 2009 to 2015. What happened was I was working in the oil industry at a W-2 job that was 98-hour work weeks away from home. I actually worked in the Middle East, in Saudi Arabia. And so you can imagine all the free time that I had to dedicate to real estate. Sure. It was about that much. And as I kept acquiring properties, I thought, digging myself a grave. This is not going to be very scalable. It's certainly not passive like I hoped it would be. I just basically created a job for myself. So in 2015, I had to kind of pause and self-reflect a lot, self-educate a lot more, go back to the drawing board and think, how could I be passive with my investing approach instead of doing all this hands-on stuff? That's where I learned about apartment syndications, the idea that a bunch of investors are pooling money together collaboratively to buy larger assets, like maybe a 300-unit apartment building. And that really appealed to me, but I was a little skeptical and I thought maybe that's a little too good to be true. Didn't really make complete sense yet. So I did one deal in a syndication. And I just kind of let it roll for about 6 months, made sure distributions came in, reporting happened, things were what I thought they were supposed to be. Sure. And I realized it's the real deal. So I fell in love with that model, that philosophy, that concept of being a passive investor, being hands off. And since then, I've just taken it full force into apartment syndications. Mostly, it's about 80% of what I invest in, and other passive vehicles, whether that be REITs, real estate investment trusts, or ATM machine investing, or various types of funds, that I'm invested in. But the idea being, I don't want to be active anymore. I don't want to do my own deals. I don't want to raise capital. I don't want to be a general partner. I just want to partner with people with track record experience and be passive. So that's what's led me to affiliate with Ashcroft Capital, Director of Investor Relations. Is I thought, what could I be doing with my time now that would be impactful, beneficial, where I could give back to others, where I could share. And that's what I do. And so it's been a really good fit. I've been investing with Ashcroft for years. And that's kind of what aligned us in the first place, was just their business model to what I was wanting to do. And here we are.
That is amazing. That is spectacular. A lot of people start off when they think of real estate as, we're exactly as you said, we're going to be hands-on, but they don't understand just the amount of hard work that it really takes to acquire property, renovate the property. I mean, it's a lot of dirty work. And so you're absolutely right that you've decided to, and it's difficult. I think someone that is looking between getting into a fix or flip or rental to say, well, you know what, let me try this model here and see how it works. But in your case, I mean, after 28 passive syndication, it looks like it's an excellent option for someone that just doesn't want to get their that's just tired of the management play, So can you explain some of those early frustrations?
Yeah. And just before we get to that real quick, there's so many people out there who, see, this was an illusion that I had, I guess, or a perception I had was if you're going to invest in multifamily or these big apartments, you need to be a very seasoned real estate individual. You've got to have, been ran through the ringer and all. But the fact is the majority of people investing in syndications like I do are doctors, dentists, lawyers, attorneys, athletes, business owners. They're high income, high net worth individuals that are just placing capital somewhere outside the stock market. They like real estate for the same reasons that we love real estate. And that's really the play. A lot of folks have never even touched real estate before. They've never done a flip. They just started in the syndication path. So that's pretty interesting. To answer your question was about kind of the frustrations or getting started and kind of the unknown. Yeah. So I knew just enough from reading a bunch of books and podcasts and a few mentors to kind of be dangerous in 2015. And so when I partnered with that first deal that I mentioned earlier, it was with a local group, which turned out to not even be significant at all, because that's part of the beauty of being a passive like this. I can invest in Texas and Florida and Arizona, Ohio, Georgia. I don't have to live there. I don't have to manage the tenants or visit the properties. I can just diversify nationwide. But for some reason, I thought it was important to be local. So partnered up with a group that didn't have a lot of track record or experience. And that was kind of my first lesson learned was I was looking too heavily at the deal itself, the pro forma, the projected returns, and thinking, wow, this thing really looks good. I want to do it, without considering who's actually going to execute this business plan and can they do that? And have they done that before? And turns out they really hadn't. So it was a little bit of a gamble with my money, which I later learned not to appreciate too much. And so I kind of flip-flop my model where I vet the sponsor and the team as the first aspect of everything. Then I vet the market and the market conditions, employment, migration trends, landlord-tenant laws, all that kind of stuff. Then I vet the deal last. The idea amazing. Being if you get the first two right, it's probably going to be a decent deal anyway that they're bringing to the table.
That is awesome. So walk us through exactly the syndication process. Someone who's hearing this, that wants to invest in a syndication, where do they start?
Yeah, good question. I think that you always want to start with kind of your goals in mind. What is it that you're really trying to achieve and why? That's hugely important. And there's too many people that never focus on that, and myself included back when in the single family game. Sure. So you need to understand, like for my wife and I, for example, we love travel. One of our passions is traveling internationally, going across the globe. And so our why, our purpose, at least mostly in the beginning, was all about the freedom over our time and the flexibility to be able to travel, to not say, well, we would take that trip for 2 months, except for we've got this deal that we're trying to handle here locally, and it requires our time and our commitment, and we just can't up and leave, or, having to have the job that holds you down to one geographic location. So we just like that flexibility of lifestyle. It's something I talk about all the time. I blog about, I'm all over social media talking about time freedom, which is the ability to do what you want, when you want, as much as you want with your time. Passive investing is really about freeing up your time. It's not about money. It's not about get rich quick. It's none of that stuff. It's just about having options in your life to dedicate your time to focus on the things that you love doing, and to have the option to not do the things that you don't enjoy. And for me, back when, it was the oil field job. I did not enjoy it one bit, and I wanted out of that as soon as possible. And passive income is what got me out of that job.
That's amazing. Yeah, definitely. You have to identify the why, and then from there just take the plunge. And what about the equity requirements? I mean, you have to be an accredited investor. Can you explain exactly what an accredited investor is?
Sure. Yeah. And so another common misconception here in the industry is that all syndications are for accredited investors only. And that's not the case. So not only are there, again, it's about the philosophy and the concept of passive income, not necessarily about syndication specifically. So the idea is that you're trying to build multiple passive income streams, right, for me, that pay out monthly because it's my income. But you can do that through REITs and high dividend stocks. And, there's other models out there for it if you happen to be non-accredited. And there's certainly a large amount of firms in the space that do what's called a 506B offering, B as in boy, where you can have a pre-existing relationship with the group. They can understand what your goals, risk tolerances, your liquidity needs, all this kind of stuff. And then they can allow, if they choose, 35 what's called sophisticated investors that may not be accredited investors. And a sophisticated investor, to define that, is just somebody who can understand the ins and outs of the deal, can understand the risks. They know what they're getting into. They understand everything about it, whether through the help of an advisor or just individually. They can qualify that way. So you can take part in syndications that way with certain groups. There's also Regulation A as in Apple, which some groups are doing in a fund structure where they can take an unlimited amount of sophisticated investors who may not be accredited. And then there are the groups, Ashcroft is one of them, that do a 506C, C as in Charlie, where it is only accredited investors. And to define that, it's $1 million net worth, whether you're single or married, excluding your primary residence, or you can qualify by income. So it's $200,000 per year in income as an individual for the last 2 years. Expectations to do the same in the current year. And if you're married, it's $300,000 for the last 2 years. Expectations in the same year to do 300 or plus.
That is awesome. That's great. And well, now you invest for Ashcroft Capital in particular. I noticed they say that they invest in emerging markets. Again, for someone who's listening the first time, what exactly is an emerging market?
Sure. Yeah. So we're not talking about like a San Francisco or a Manhattan, right, or something like this. So what we're looking for are, I'll give you some example markets, a lot of suburbs in Dallas, Fort Worth, Richardson, Haltom City, things like that. Out in Florida, we invest in Tampa, Jacksonville, suburbs of Orlando. So what we're looking for are basically employment diversification, because at the end of the day, what are we talking about? We're talking about tenants and people who are renting our apartments. They need to have jobs, and we don't want to be overly reliant on one industry, like oil, or like we saw in Detroit with the car industry. And then that one sector comes down, and then the tenants are all out of luck, and so are we. Yeah. So you want, for example, I forget the exact statistic, but in Dallas, Fort Worth, it's something like there isn't any one industry that makes up 20% of the job market. So you're very well diversified there, right? And migration trends play a huge role as well. Right now, we have a lot of New York, New Jersey individuals moving down to Florida, for example. You have a lot of people leaving California to come to Texas. So just tracking those macro level trends, and companies also relocating to these markets as well, makes for some good variety and diversification as a safety net to the deals that we do.
That's amazing. That's amazing. And as far as the tax benefits that come from passive investing, can you get into some of those details as well?
Sure, with the disclaimer that I'm not a tax professional or CPA, sure, so please seek your own advice here. But, I think most people are aware that real estate holds some tremendous tax benefits. What's different in the space that I play in as a limited partner in syndications is when you have a larger apartment building, a lot of groups, Ashcroft included, will do something called cost segregation. So what they're doing is when we close on a new property, we can actually go in and we can accelerate the depreciation or the tax benefits on certain items over the property. So this is like a third party survey, more or less, that you pay for or report. And so they're taking things like electrical and plumbing and wiring, cabinets, appliances, light fixtures, carpet, things like this. And they can accelerate instead of depreciating it over 27.5 years, which is what the IRS allows just in general for straight line depreciation on real estate. You can do 5-year to 7-year lifespans on certain categories. And so what that ultimately means, to kind of jump out of the jargon, is that, let's say I invest $100,000 into an apartment syndication, I might get a tax form that says something like negative $40,000 on my taxes. Now that's a paper loss. I didn't actually obviously lose $40,000, but I get to deduct that. So it becomes a highly tax advantaged play. All in all, plus you're looking at long-term capital gains on the backside, assuming there's a profit upon sale. So very tax advantaged all in all.
Excellent. Yeah, that was one of the best explanations I've heard in a long time. That's a great explanation. So the other thing I want to point out, on a syndicate, and I know that there's different investment vehicles that we've been talking about, but just going back to the syndication specifically, you mentioned, well, we haven't mentioned this just yet, is the timeline. At what point is there ever a payout? You get into a deal. Are you looking at the payout in 5 years, 10 years? Is it at the general partner's, will? Can you get into some of those specifics? And I'm sure that each deal is different, but.
Exactly. Yeah, that's the first caveat. Every syndicate group is different. Every philosophy out there is different. So again, it gets back to, what do you start with? Your goals, your criteria, your why. So you're looking for a group that aligns with you in philosophy. There's groups that you can syndicate with where you invest and they never project to sell. They just say, we'll sell when we sell. It could be 5 years, 10 years, 20 years, 100 years. We don't know. There's that model, if that resonates well with you, and they're going to try to refinance your capital back to you over time. There's also groups like Ashcroft, which is probably the norm, that do these 5-year underwritings. So they're projecting a sale in about 5 years. It might come at 3, it might come at 4, it might come at 6, but in general, 5. So I look for, personally, value add projects, meaning that we're fixing the projects up, that we're buying them where the rents are below market value. We're trying to raise those back up to market by implementing, new barbecue areas, covered carports, renovating the units, rebranding the asset, upping the landscaping. There's a lot of things you can do to these properties that are commonly 1980s, 1990s, early 2000s. They have been deferred a little bit. Whoever was holding them previously, for whatever reason, wasn't keeping up with all of this and decided to sell. We come in and we renovate. So with a value add stabilized asset, stabilized meaning that the occupancy is high upon takeover, might be in the 90% range, they're cash flowing assets just right out of the gate. So something I look for is monthly distributions, as I talked about earlier, because it's my income. That may not be important to everybody. The industry norm is probably quarterly from what I see. And so, what you can expect is, let's say we close a property today, your distribution might come as soon as, 45, 60 days later, somewhere in that time frame. And then it distributes every month. And then sometimes a refinance happens if applicable, if possible, and then you'll get some of the invested capital back, is the idea behind doing that, because there's enough equity in the deal. Or you're just waiting 3, 5, 7 years, whatever the business plan is, to where there's a sale. So you're getting cash flow the whole time, and then hopefully 5 years down the road, you're getting a big equity pop on the back end upon sale. That's kind of what the business model is. So it's kind of half cash flow and half equity. Not exact percentages, but something like that.
You hit the nail on the head, and I've mentioned this to a lot of people. It's, when you're looking to invest in real estate, look at the cash flow, look at the equity, and you're getting that without, again, having to just be, and you said it best earlier, which was, you created a job for yourself when you bought the properties and you were managing them yourself. It's very time intense. Whereas now you're getting the exact same cash flow, you're getting the equity, and it's passive. I mean, it's a beautiful model. Now, what are the sort of returns that someone can expect on their money?
Yeah, good question. Again, the disclaimer depends on the group, depends on the
course,
property,
absolutely.
the deal, the market, everything. But in general, just use ballpark numbers. This is not specific to Ashcroft or any one group, but you usually have what's called a preferred return, meaning that the limited partners, which is me and anyone else investing in a syndication passively, it's not a guarantee, but it's basically the first amount of income that's coming off the property is going to the limited partners. And it's like a benchmark threshold before the general partnership starts taking their fees and their splits and all of that kind of stuff. So those can range from 6 to 10% a year. And that's our cash flow that I was talking about gets distributed monthly. That's from collected rents and other income generating activity on the properties. And then you have what's called an IRR, which is an internal rate of return, which is essentially, it's a complex formula, but to simply put, it's kind of taking the equity on the backside plus the cash flow and then kind of merging that together and saying overall, your annualized return was about this much here. And those are usually double digit. So, they could range from 12% to 20%. They're somewhere out there. So again, assuming a business plan gets executed properly and market conditions hold up and all this kind of stuff, you might be looking at, let's call it a 12 to 15% annualized return when you're factoring both of those in. Just keep in mind that equity may or may not be there, and it's going to be down the road. That's going to be like 3, 5, 7 years down. So you're not getting, 15% a year kind of thing. But yeah, that's generally kind of how it works.
Phenomenal. And yeah, that's a great explanation. So, I want to thank you for being on the show, Travis, today, for taking the time to come on. And if anyone wants to get a hold of you, what's the best way they can reach you?
Sure. Yeah. Ashcroftcapital.com. I have a link set up. What I do is week to week, I have these 15-minute calls with anybody and everybody just to talk real estate, talk passive investing, talk syndications. We talk about all kinds of stuff. They're free calls, and you can set one up at ashcroftcapital.com/connect with Travis. And in there's a whole lot more info and resources, stuff like that. So that's the best way to reach me. I'm also on Instagram, Bigger Pockets, LinkedIn, Facebook. Instagram's at Passive Investor Tips. So is Facebook. So feel free to reach out there as well.
Thank you so much, Travis. It's been a pleasure. And if you like what you've heard, again, hit that like button, subscribe to the channel, and go ahead and check out our partner, Element Studios. That's EL3 MENT Studios. They do great corporate headshots, real estate photography. And Travis, it's been awesome. Thank you so much.
Thanks, John. I really appreciate it.
All right. Take care.